We've got GDP at 3.0%. We've got unemployment rate currently at 4.3 with the big number coming out Friday. We've got PCE core inflation at 2.7. We've got people in the market saying rate cuts are coming. We've got the September stock market at open down 500 points. We've got an election in like 70 days or something. Lots of stuff going on. We're going to talk to Anna Kelly about the Fed, about rate cuts, and what she sees coming. Anna, wow, lots of stuff going on.
There is, and it gets curiouser and curiouser as we go, right?
No doubt, no doubt.
So many things. I think it's about 100% bet now that the Fed's going to cut rates in September, and I would agree with that. The question is, how much do they cut? If they cut too much, does it look like political influence and election interference? To some people, they'll say that no matter what. And if they cut too little, are we going to go into a deep, deep recession? And so I'll just throw out there, I think that they might come out of the gate at 50 basis points. I think it's probably more likely 25, unless there's a lot of softening in the job markets in the next couple of days, which I don't think that's going to be. But I will say that I think they need to cut 50, at least. If they cut too much more, it'll create a quick market panic. If they try to come out of the gate with 75 or 100, I think they would say, whoa, the Fed really sees so much softening. This is a trouble. And historically, through the average across recessions is when the Fed cuts rates, the market collapses 30%. That's historic. And the market has already priced in these rate cuts, some of them. And so I don't know that you're going to see that immediate, start to spiral down to 30%. It might be less than that this time because there is some money on the sidelines and because they're already predicting the rate cuts. But I do think that if they came out with more than 50 bips, it would create some panic. So I don't think they're going to do that. But I think that they are behind the 8 ball. I think that they should have cut. I've been on this, show at least a year now saying I think we're almost in a recession or there. I still believe that they may very well, the NBER backdate a recession to the end of the third quarter or beginning of the fourth quarter of 2003, based on all the unemployment numbers that you and I have talked about. I kept leading up to, we've triggered the McKelvey rule, unemployment's ticked up 0.3% in 3 months, and that always indicates a recession. And now we've triggered the SOM rule. Unemployment's ticked up 0.5% in 3 months, and that's been triggered. And so you're seeing, job misses of 800,000 over-reported jobs that weren't there. And you and I've been talking about since the first quarter of this year how even the new jobs created, there's actually negative net new jobs, new full-time jobs. They're almost all government or healthcare, and it's still negative to full-time compared to private sector, or they are multiple part-time jobs. We see massive upticks as of today, almost 9% credit card defaults and almost 9%, 8.1 is one of them and 9.1 is the other for credit cards and auto defaults. And there was a new study that just came out, I believe it was last Friday, 50% of Americans now are check to check with debt and less than $500 in their checking account. It was 70% had less than $4,000 in their checking account. Now it's, 70% living check to check, 50% not even having $500. So that is going to pull on the economy. People are tapped out. They're going into default. And one other quick thing, the end of September, all of the deferred and non-paid school loans are going to start reporting to the credit bureaus. And so when you start to have those delinquencies shows up and the American consumer is tapped and afraid of what's coming next after election or recession, that's going to really drag on GDP, spending, inflation. It's going to help bring that down. But I think it's going to push the NBER to where they see that the coincident real-time indicators, the leading indicators, start to also go recessionary, and we will be in the throes of a recession. That's my call. That's my belief. When it's declared, I do not know, but I believe that it's coming. The Fed sees it. The Fed will react with heavy rate cuts, but I think they come out of the gate, small rate cuts. And then after the election, I think, as more starts to materialize in these indicators, they will start to cut rates pretty drastically.
Well, let me ask you one follow-up question, because we disagree on this, and the audience always loves that. How much do you think they cut by the end of the year? There are 3 meetings left, September, November, and December. What do you think the total amount of rate cuts are?
I would say, consensus is 100 basis point, which is 1%. And
Mhm.
I think that that's reasonable. I've learned it's really hard to predict because there's so much data that comes out across 2 or 3 months, and this Fed is not ahead of the data as I think they should be. There's plenty of data that has been showing strain for a while, and it's like suddenly the Fed is like, oh, okay, it's starting to soften a little more than what we thought it would, the labor markets, right? And
Mhm.
so we're going to be data dependent in real time, when the reality is they know leading indicators and they start to see a lot of this stuff happen, but it hasn't gotten bad enough that they're reacting in advance. And so since this Fed has not shown over the last 2 years really being ahead of the data, they've taken kind of more of a real time data, coincident data, then will react. I don't think they're as head of the data in their rate cuts. I don't think they're going to
Mm.
go, whoa, the recession's really coming, so let's get ahead of it. They've proven that they're not doing that. And so
Mm.
I don't know that they will go as deeply into cuts as I think that they should, until the data is so bad in real time that by then you're already in a recession. The stock market tanks its
Mm.
30%,
Right.
um, historically, right? And that's when you start to see incredible uptick in unemployment. And only until you get that incredible uptick in unemployment, which is the last of the indicators
Mhm.
to hit once you're in a recession, that the Fed goes, okay, now we have no choice but to cut much more deeply, closer to that zero bound interest rate that Powell has been, really been trying to fight to have enough cushion in where rates are today that he doesn't have to go back to 0 or 0.25, because they don't want massive amounts of QE to spark huge, inflation again. And so I think they're going to be more measured to not go as low as they have in the past when you're in a recession as quickly, because they don't want to spark inflation again. So
Mhm.
I could be wrong on that, but I tend to not think they're going to go into deep cuts until the NBER declares the recession or unemployment really starts to uptick, and then they're going to be forced to have to cut rates really low. But I think based on a lot of different data that I've read from the Fed, the Congressional Budget Office, and their joint meetings, they don't want to go below 2%, even during QE. And so, that's still 3.25 point drop that they could go if we're in a deep recession to get rates to there. And then I don't think they'll go much longer. So if I were betting,
Mhm.
which I don't do because my timing's always wrong. I mean, I know what's coming. I see the data, the writing's on the wall, but we underestimate how long these lags can be in a period where there was so much stimulation, and some of
Yeah.
that stimulation still there boosting the economy, for the haves, even though the have-nots don't have anything. So I would say 100 basis points by the end of the year, unless unemployment materially comes down. We saw a manufacturing, slump again this month that just came out today. And
Mhm.
that drives the economy. And so I think as the data continues to weaken and get worse, meaning less growth, more pressure, less spending, less profits, you're going to start seeing profits come down, by more and more companies. I think that it's going to force the Fed to cut deeper once that data materializes. Whether that happens by the end of the year or not remains to be seen. But once it does, they will cut much more deeply than 100 basis points, down to maybe 2, in my opinion.
So that was where I was going to go next, because all these rate cutting cycles, like they never stop at one or two cuts. They
Yeah.
go to some level. So you think it's possible maybe by next summer, I'm just artificially picking that date, we could be down 325 basis points to that 2% bound? Do you think
Yeah.
do you think we get that low by the summer of next year?
If things continue to down cycle as they have been, yes. It's really difficult to get the timing right. It just
Mhm.
is. But I will say
Yep.
that once you start to see these recessionary indicators, like the SOM rule, it
Mhm.
indicates we're in recession. Um, the hard thing is GDP got revised upward, right? And so people are like, the economy's still healthy. Yes, jobs are soft, but it's still only 4.3% or whatever unemployment's going to be, but you've
Yep.
still got people spending. But I think the difficulty of data like this is we know that, one, some numbers are purposely manipulated. They just are. And I'm not a conspiracy theorist, but I know the data, and I know, it doesn't look good for them to show negative before an election. So they want to, so for example, the government will go out and create more jobs and spend and stimulate in certain things to just create enough push in one sector of the economy that it floats the rest to a positive GDP number, right? But the other thing is some of the data is just flawed, and it still hasn't been corrected well enough to account for things like immigration. And, for example, this unemployment number that was the number of jobs created was revised down, back under 800,000 off, something like that, 800,000 plus
818,000. 818.
Okay, good. I was going to say 819, but sometimes the lagging numbers are not in my memory. But 19,000 jobs, right?
Right.
Those numbers are used in assumptions about payroll and GDP. They make assumptions of how many businesses are starting or going out of business, the birth-death model of businesses.
Yep.
And what you see is when the first number's off, the number of jobs, it then skews to the upside and makes things look more positive, like GDP, that are really not there. So it's really difficult for a layperson or even someone like us that's not looking at the data in detail every single month to say, what is the real state of GDP? So here's what I do, just putting on my hat of experience and learning from the past and the things that I didn't see that led to the GFC that now I see now, right? And one of the things that I look at is the money supply. And there are different schools of thoughts about economists. So you can think this is what should happen, but not realize that the economists making the decision don't look at that type of model. So for example, Lacey Hunt is somebody, and Steve Hanke, that really look at the money supply. And they say, if money is pumped into the system, it's going to then result in incomes and productivities going up. And if money is pulled out of the system, it's going to result in layoffs and people pulling out money and not investing and not spending. And it's going to be a drag on the economy. Okay. So some schools of thought say the money supply no longer works. We don't have to worry about it. But money supply, just like the SOM rule, has history of getting it right when it's predicting something bad's going to happen. And there's money supply has come down significantly to the lowest level from its peak, other than 2 times in history. And that's the Great Depression and after World War II. So anytime that money supply has collapsed to the extent that it is today, and I don't remember the exact percentage, so I'm not going to try to quote it and get it wrong and say, Anna, you're wrong, right? But whatever the percentage is today, and the decline of the top of the money supply has always precipitated a recession of some sort. And we're at a level of difference today that has only been seen just before the Great Depression and World War II, when we spent a lot of money. So that's one thing. So as the money supply comes down, the question is it still working because there was so much artificial money before that maybe the change in the delta isn't really that bad, right? The other thing is they look at gross domestic income and gross domestic product. And GDI is something that not a lot of people look at, but I'm watching very, very careful, because everyone's just saying, what's the headline GDP? It means we're producing something positive net. But the theory is whatever you produce should go into incomes. And GDI is the incomes of government, private companies, households, and what's in the banking system, right? Investment dollars, but it's basically incomes, interest income, for example. So if you are producing a positive GDP of 3%, let's just say round number, then your GDI should also be 3%, because every dollar put into the system is somebody else's income. Even if you take debt, that's income to me in interest payments, right? Right now, they should theoretically be about the same. GDI is negative 1%, where GDP is 3%. So there's a 4% gap, and I'm rounding the numbers. It changes every day, right? But it's widening, Michael. That gap is widening, which means that the GDP numbers that are being produced, partially artificially and calculated and extrapolated, just like I talked about from numbers that were not right in the jobs created data, I think that's artificially high. And I think if you look at GDI being negative, we see that the income is not trickling through to the majority of the population. And the fact that 70% of people live check to check, 50% only have $500 saved, defaults are rising in almost every area of the economy, and people aren't even paying school loans yet. It tells us that it's continuing to weaken and that something in the data is not right, because GDI and GDP don't match. And anytime you have negative GDI, it always results in a recession, Michael. That's just what the data says. And so I don't see anything in the economy other than the hope of AI and weight loss drugs, right? And maybe some cancer drugs. It's like AI and healthcare are floating the S&P, and they're the hope that that's what spikes the next round of production. So if the economy is starting to contract in all these areas that we just talked about and more, manufacturing, et cetera, where is the thing that's going to stimulate and keep GDP high? Why isn't it trickling through the income? And I just don't see any really stimulative thing that across the breadth of the economy, not just a couple of sectors, is going to spark that next round of expansion that we want to see, that's going to keep us out of a recession. And so it's not just that I'm looking at unemployment going, it's recessionary, and people are saying, you're a doomer, Anna. No, it's look at GDI, look at the money supply. All of these things historically have accurately said, we're in a recession. And once you start that spiral from an expansion to where you are in a contraction, you've never not had a recession when all of those things are aligned, and they generally are a deep recession. And so that's, part of the reason I'm saying, could we end up with a 2%, Fed funds rate in the summer? We've got 9 months to get there at this point. 9.5, 10 months to get there. A lot of those things that are already happening will continue to get worse once the Fed cuts rates. Historically, unemployment will grow, and those numbers are just going to get worse. And so I see a potentially fairly deep, longer than average recession. And if that happens, the Fed will have no choice but to use QE like they always have. I'm not saying they should, but this is their tools. They will use QE. Congress will stimulate. They'll put a bunch of helicopter money in the system, and they will try to work together to stimulate that growth to get us out of a recession when there aren't other areas of the economy that are going to stimulate us enough. And if there aren't, then that means that the recession could be longer and deeper, causing the Fed to cut rates again and keep them low longer than they would like. I don't think they want to, but I think that's the reality of where we might go. I hope that I'm wrong. I hope that it is different this time, that we don't go into a deeper, long recession, but history rhymes. It's not exact, but history rhymes. And the other thing is, globally, Michael, there are not other countries that are better off than we are. So, after the GFC, China came in and really helped the economy in a lot of different ways, and they helped stimulate because certain countries were doing better. We don't have that. We have global, at least flat, and multiple countries, technically now in a recession. So I just look at history and I say, every time that they say it's different this time, including in 2007, right before 2008, it surprises to the downside. So I'm preparing for deep recession, lower rates. I don't like it for the world and the economy, but I'm excited about the opportunities that's going to bring me as an investor. And I am going to buy more property when I think we're close to the bottom. I still look at properties every day, even though I haven't bought anything in a while, quite frankly, because I've been in preservation mode unless the return is really good compared to the risks that I think lie ahead. And I'm going to buy a lot of properties, and I'm going to lock in rock bottom rates. I'm going to do more DSCR loans instead of bank loans so I can get 30-year fixed financing on smaller properties. And that is a good thing for me. And then I'm going to hold till however long this recession lasts, however deep it goes, to get through a recovery until we do have the next expansion, even though I'm expecting that to take longer time. So this is not all doom and gloom. It's the reality of what the data says, and where I think that the real data that has a great track record points us to, not the rosy picture created by a GDP print.
Yeah. So let me kind of give the audience my thoughts on all of this, because we do have a topic number 3 I want to get to. First and foremost, I'm going to stick with my no rate cut in September. At this point, it's a week away. I don't feel like changing my mind.
I don't think we've ever varied this much. So tell me why, Michael.
Well, again, part of it's because I made this call 6 months ago, and I don't like changing my call. I realize the market is calling for a 25. if not 50. I think the 10-year note's down 7 basis points today. So I think they're already pricing in a real shot at 50. I just don't like changing my opinion this close to the decision. It feels improper. But the reason why, you kind of said it, GDP's 3. Like the Fed has told us, Powell has told us, data dependent. And thus far, unlike past presidents, you could take him at his word, right? Because everything he's told us he's going to do, he's done. So I'm like,
Absolutely.
okay, guy, you're data dependent. So we just got a 3% GDP. We have unemployment at 4.3, and I think might shock people and go to 4.2 on Friday because I think the hurricane in Texas kind of jumbled the data last month. So I think there's a chance unemployment goes down. So you have GDP at 3. You have the potential for unemployment to go down. You have retail sales last month surprised to the upside by a full percentage point. And yeah, there's a whole bunch of pain in housing, and it's a buyer's market now and all of that. But I don't know how you could look at this situation. And of course, there's an election 6 weeks later, and you can cut rates. I think it will be seen. I don't think Powell wants to be seen as being political. The only way, in my opinion, they cut in September is if the Friday's jobs number is negative and unemployment spikes to like 4.5. They have to make it clear and cut problem, in my opinion, to cut in September. But that said, you and I both agree they do 100 this year. We just disagree on how we get there. I think they do 50 November, 50 December. So we agree on that.
Yeah.
And then I think the bottom is 3%. You think the bottom is 2%. I think it has to get really ugly. And this, again, is where I think we disagree. I think you have a fear of a deep and dark recession, which, again, it rhymes. I actually think we're repeating something that's only happened once in our adult life. Frankly, once in our life, including when you and I were kids. And that is, I think we're experiencing a rolling recession. It just feels different.
Yeah, and you and I talked a lot about how it's looked like a rolling recession for over a year, for sure.
Yeah, exactly. So I think that's, when this is all eventually backdated and it's in the history books, this will be a longer recession, but shallower. So the totality may be worse, but it will be a longer and shallower. Hence, I think they only go to 3% versus deep and dark 2%. Because I agree with you. They're not going back to 0.
Yeah, they want to prevent that.
They can't do it again. GDI, no opinion. I haven't looked at it. I have to, especially with its delta to GDP. I'll look at that today, so we're ready to talk about it next week. I do want to talk about M2 money supply, because you're absolutely right. M2 money supply going negative has only happened a couple of times, and it's been deep, dark, and scary. What I would ask you to do is go back and look at the chart and zoom out. It is true. M2 money supply is down something like 9% or 9.3, something almost double digits. But if you zoom out, you will realize we're not even to trend, right?
Yeah.
If you go back and you look at M2 money supply over the decades, we did so much nonsense during this pandemic that we exploded M2 money supply. And oh, by the way, in the last month, M2 money supply has turned upwards. So it's going up again, which just makes no sense kind of with all of this going on. So in my opinion, I think we do get 100. So we agree on that this year. It is really my hope that we don't do September unless it's deep, dark, and scary, like 4.5 on Friday. But yeah, I think it's like you, that kind of round out is I'm excited for what's coming.
Sure.
I don't think there's going to be any real crash in residential prices.
Right.
I think all the pain is in the small, in commercial, five and above. And I'm licking my chops. Anna, there's a very good chance. I mean, just think about this. This election happens, and they do something to stimulate residential, first-time home buyer, whatever, 40-year mortgages, whatever it is they do. Because whoever gets in, they're going to do something to residential housing. So they goose residential, which increases demand, and we don't have supply. So the low end, first-time homeowner stuff goes up, pick a number, 8, 10, 12%. Right as all this commercial debt blows up, because I think we got like $1.8 trillion or some crazy number of extended pretend going on that can't go on forever. There's a chance you and I 1031 out of residential into larger multifamily. And I've done that before, and it's amazing. And I think I might get a chance in 2025.
Yeah, I mean, there's so much to unpack there. And this is why, it is important to understand that all of us do, to your point, we all have some biases, and our experiences shape our biases. And where we are economically shapes our biases as well. And so for me, yes, I've been through the GFC. I went through Enron collapsing. I went through the dot-com bubble. I saw,
Me too.
my grandparents, struggle with previous recessions. And I was being raised in the 70s when inflation was high and my parents were living check to check. And so I've worked so hard to create what I do have that I'm in a place that says, I can afford to be patient.
Mhm.
And something Ray Dalio says that I really like. He's somebody that I respect a lot for his economic acumen, whether you like him as a person or not, right? But he says when you have to worry is when you don't worry. And when you
Mm,
worry is when you don't have to worry. When you fear, you don't have to fear. When you don't fear, you do. And
right.
what that basically means is if you can look at realistic data, you have to look at data, you have to look at history and say, most people have a 10-year bias. We think whatever's
True.
happened in the last 10 years, that's what it's going to look like in the next 10 years. And people that do really well with investments, they look back much further and they say, I'm not unique. I'm not special. This time period isn't unique and special significantly.
Right.
Patterns happen over and over and over again in history. And that's why they say history rhymes. And so if we can look back and look at the data and say, what does history tell us historically is likely to happen in the future? And it's essential risk mitigation. How do I mitigate risk? I have to understand it. And so
Mhm.
if I can look back and say, all these things have historically led to X, let's say a recession, maybe a deep recession, then I'm going to say, I'm going to worry about that. But I'm not going to worry about it to the point that it paralyzes me. I'm going to worry about it to say, this is a real risk. And if I'm currently in asset preservation mode, I no longer am trying to grow income or grow net worth to the extent that it's my number one financial goal. My number one financial goal, Michael, in my point in life and investing is asset preservation. I want to preserve what I have. So I have to look at if I find an amazing deal that grows income and net worth, I'm going to do it as long as I can account for what I worry about. So if I think the recession is going to be deep and maybe wide, then I now have the tools to say, here's a risk. How can I personally mitigate this risk with this deal? If I think that I can, if I think 80% of it's within my control and the 20% I worry about is not likely to happen or it might, then I can make all the plans for how I'm going to steward that deal, that let's just say the multifamily deal, right? How I'm going to pay my investors if a recession's deep and my vacancy ticks up and my tenants don't pay and I can't evict them, right? Or there's national rent controls, which are on the table, right? Legislative risk. If I can mitigate a lot of that risk, then I do the deal for more income and growth. But if I can't, and it's so volatile as in a transitional economy that I feel like the risks are too high and more probable than the little risks that I fear, like let's say war. War is probable more so than it was a couple of years ago pre-COVID in multiple different sides. Does that mean it's going to happen? No. But if war happened, how would I mitigate my portfolio? So I don't have a deep fear that's paralyzing me from real estate's terrible, the economy's terrible, I'm never going to do another deal. I have a cautious asset preservation mode that says the probability of these things is higher than what I think you want to hope that they are. But
Yeah.
we have different perspectives, right? And I am more cautious because I am in wealth preservation mode. But people that are not there yet, that really need income and really need growth, you need to be careful that these things could happen too, and you need to have a plan. So, for example, Michael, just something tangible for your listeners. When I bought property in 2007 and I thought it's rosy, like everyone else said it was different this time, I went into $700,000 of debt to start a business and to buy property at the worst possible time that I could go into debt. And by the way, interest rates were high and they were locked in for me. And then we had this recession. Many people have been warning about it, but nobody like me listened. Nobody in the financial market listened. It's different this time. So I experienced the pain of making that bad decision. So I had no extra cash. So I bought deals. And then when tenants couldn't pay, I'm like, oh my gosh.
Oh,
Or when an AC unit went out. I have no money to cover this AC unit, and then the tenant's going to move out, and I'm not going to have the money, and I'm going to be negative. It was a bad decision. If I thought a recession was coming, I still would have bought the property. I wouldn't have started a business. My husband would have gone to work for someone else. We still would have bought a property, but I would have made sure I had cash reserves so that if people lose their jobs and tenants can't pay, I can cover that. I don't have to underwrite my deals to 95% occupied. If I think a recession's coming, I'm going to underwrite them to 90% occupied, and I'm going to have 6 months of property expenses sitting in a checking account so that
Mhm.
maybe if the recession happens, I'm still okay. I'm still buying property. So that's how my mind works is what I feel, what I see becomes what I fear, becomes what I prepare for to help me to make better decisions when I do buy a property to take opportunity. So does that make sense? It's not doom and gloom.
Mm.
It's let's learn from the past, prepare for the worst, hope for and expect the best, and continue to move forward with things that do make me more money, do make me more income, do grow my net worth, but not being so rosy optimistic, which is why so much commercial real estate is in distress today, because it was that rosy optimism that hasn't played out.
Yeah, you and I have talked about it before, but it bears repeating. I find it almost comical. If it wasn't so sad, it would be comical. We repeated the same stupid things in the commercial market that we did in residential in '06.
Yeah.
Short-term variable rate debt, horrible bad assumptions. We assumed everything would go up. Uh, it's just it's comical to me that we did it again, just in a new asset
Yeah.
class.
Right.
And the pain is coming. And again, my market, just so people realize how bad it can get. My market of Fresno, California, I sold my very first property we bought for 260 something. It went all the way up to 300. And then
Yeah.
over the next 2 years, it proceeded to fall to 75 grand.
Right. And that's happening in commercial. And so part of my, not so rosy expectations for the next year, hopefully not more than a year, but could be, let's say longer, is commercial real estate is down 30 to 40%. And
Yep.
there are over 2,000 small to mid-sized banks who now have 300% of equity in expected commercial real estate potential losses. And that
Ouch.
usually leads to bank failures. There are
Absolutely.
expected to be at least 500 banks that are forced into consolidation based upon their bad commercial real estate debt that will have to be moved to they'll have to be written off. And if that
Yeah.
starts to happen, it's not necessarily a banking crisis, but more banks are in trouble now than were in 2009 in terms of the amount of debt on their books that is going to go bad. And Rebel Cole is somebody really
Yeah.
good to follow. He's done a lot of studies on this, but if we haven't seen the fallout in commercial yet,
Not
it's
yet.
going to
It's
get worse
coming.
because a
It's
lot of the
coming.
banks have extended 1 year. Like and there's a lot of things that have had to happen to make that happen, but they basically 95% of loans right now in commercial is what I just read, the Moose and Sat. If you are in a bridge loan, they're giving you 1 more year to extend and
Yeah.
hope that everything, comes back okay. But if they can't, there's a lot more fallout, and that's going to impact your bank's ability to lend. And so if we do
Yeah.
get into a recession, the only reason I
Exactly.
think it could get deeper than you think is because if we're in a worse recession and more of these banks do start to have to write off and write down, and you start to see these mergers, banks are going to tighten credit even more than they already have once we're in a recession. And so that keeps us from, again, being able to stimulate the economy with a whole bunch of purchases, even if rates are low. If the banks aren't lending, that is a really slippery slope that very quickly can make a shallow recession much more deep. And so I'm a
Sure.
little worried about the health of the small and regional banks that fund most commercial real estate and most small businesses. And so that's just another thing that's making me say we
Yeah.
have to be aware that these things, we haven't seen it yet. It hasn't
Right.
happened yet, but it's coming. The question is, how bad is it going to be? And I don't know. Nobody knows, because we also don't know what the Fed and the Congress are going to do to
Mhm.
backstop all of these things. And they've been able to come to a temporary rescue and get us out of recessions more quickly than we've thought, just like during COVID. But there's always downside risk to that. And so, I'm
Yeah.
just old enough to have enough wisdom to say, I don't know. But I'm preparing for bad and then looking at bad as big opportunity for me as well, to be a good person to the people that are struggling when it is hard, but to
Yeah.
also take the opportunity to do really great deals that could change, your family's future because
Yeah.
you're brave enough to go into the storm. So I always want to end with there's opportunity here, right?
Yeah.
But know what you're dealing with. If you're listening to the headline news and where the stock market is and where GDP is to say things are going to be great, you could make some big mistakes with debt and getting yourself too strapped and not having reserves. And so a lot of these things are solved, Michael, by doing only great deals, not mediocre deals, having a lot of extra cash flow, cash reserves, and not doing bridge debt. Even if you
Mhm.
think rates are going to fall, lock in your loans. If you can refinance later and do better, great. But don't make assumptions that things are going to be rosy in a couple of years and do short-term,
Yep.
short-term loans with rosy glasses. That's what's going to get people in trouble. And that's what I'm trying to save people from is being too rosy and then paying for it with a decade of your life like I did.
There you go. Anna, where can people find you?
You can find me here on your show every week, almost every week, except for when we're having fun on vacation. And you can find me on social media, Anna Kelly, REI Mom. And for real estate coaching, consulting, and investment opportunities for accredited investors, you can find me at AnnaKellyInvesting.com.
Awesome. Thank you so much.